Hello friends, welcome to my channel. Today I am going to talk about revenue recognition and revenue cutoff procedure. Revenue cutoff procedure is one of the important activity which is performed by the R2R team or GL team of the company. They coordinate with the marketing team, try to get lot of data about the sales, and then they decide which revenue to be recognized and which revenue has to be deferred. Now when it comes to revenue recognition, there are few points which we have to keep in mind. There are few conditions which we need to meet before we recognize any revenue, or else it has to be deferred. One of the first important condition is that the risk and reward on the product has to move to the customer. And second condition is that the control of the products move to the customer. That means as a seller, I don't hold any more control on the product. And third condition is that you are having 100% assurance that the payment will be received from the customer. So these are the three important conditions. The most important part is that the risks and rewards should transfer to the customer. Now I'll give you an example so that you can understand that what is the meaning of risks and what is the meaning of the reward. When it comes to risk, for example, you are going to a shop and you are buying eggs. Now when the shopkeeper is packing the eggs, if any one of the egg is broken, definitely you'll ask him to replace, right? Why? Because the risk was with the seller. He was supposed to give the product at good quality and it was not made. Hence, you as a customer, you demanded him to replace the eggs. Now, in this case, the risk is still with the seller. But take a case where the seller has billed and he handovers the eggs to you. In that case, the risk is with you. So, when you are coming to home, if something happens to the egg, then you are going to take the damage, right? So you can't go and ask the seller to replace it once it is handed over to you. So this is risk. And what is reward? Reward means when you use the asset or when you use the particular product and get the benefit out of that, right? For example, if as a manufacturing, I am buying raw material and the raw material are in my godown or in my warehouse, then I have right to use this raw material and convert to manufacturing goods, finished goods, and take the benefit of that. So when you see risks and reward, the question is that how in the business we have to find out that whether the risk reward has been transferred or not. So in business, when you are preparing a contract or PO with the customer, there are few conditions which is generally mentioned in that. And what are these conditions? These are called as Incoterms. So you may have X work as one of the Incoterms, FOB, CIF. So there are many Incoterms in the market, but very rarely all are used, and very commonly what is used is X work, FOB and CIF. So when it comes to X work, the risks and reward transfers when the goods moves out of the factory gate, right? For example, you have a contract with the customer and the contract says that the input term is X work. So once the goods moves out of the factory gate, your risk is transferred. That means you can recognize the revenue. It's the customer who will be taking care of the goods from the warehouse to his own warehouse, from the factory gate to the warehouse. Now, coming to CIF and FOB, these are commonly used when you are exporting the goods outside the country. So, if you are exporting outside the country, the risk and reward will transfer only when you get the bill of lading document from the shipping company, right? That means the goods still, if it is available in the custom area, you are responsible for it, and any damage in the customer area, the seller is going to take care of that. The customer is not going to bear the cost. Now, this is what we talked about the risk and reward. When it comes to revenue recognition, I have explained you the conditions, but now when it comes to revenue cutoff procedure, these conditions, whatever I explained you now, the R2R team has to validate for each transaction what has happened during the month and check that whether the risk and reward has been transferred. So for that, what documentation is required? So if the condition is X work, the R2R team has to validate checking the sales register and the material outward register, which is maintained by the security guard. So he has to take the copy of the material outward register and check that whether all the products which has been billed during the month has been transferred or not. If it is not transferred, then he has to reverse those entries. Now, while reversing these entries, one point has to be taken care here that not only the sales entry, any connected entry for that product has to be reversed. For example, your cost of goods sold. And if there is any standard warranty or there is any commission attached to the dealer and you have accrued those provisions also, that has to be reversed. That means it has to be treated that no such transaction has happened during the month. It's not that only you reverse the sales part. Now, coming to the second part, when the sale is CIF and FOB and it is an export sale, in that case, you have to collect the bill of lading document and find out the date. If the date falls within the month, then you can recognize the revenue. But if the date is after the month, That means when you're closing the books and the date is on that day or maybe not within the period you're covering, then you can't recognize the revenue. So this is how the revenue cutoff procedure is checked. One more important thing here is that as part of GLT and R2R team, you have to go through the contract and find out, are there any performance obligation or bundled performance obligation which is given to the customer. If it is a bundled contract, then you have to split the performance obligation. You have to see that how the transaction price is splitted between the two performance obligation. That is very technical, and you have to see that what best way you can distribute. There are few formulas in IFRS 15, you can apply that, but always see that the right allocation is done. And all type of direct benefit given to customer like rebates, volume discounts, quantity discounts, or financial subsidy, those are netted off with revenue when you're closing your books of accounts, right? Now, after revenue calculation, the most important part is that check that what type of provisions you've taken towards ECL, that is expected credit loss, right? In that case, you have to see that if a customer is continuously failing to make the payment on time, or the customer has a bad experience, the company has a bad experience collecting money from the customer, in that case, you need to create a provision for ECL, but it has no relation to revenue, right? Revenue is booked, recognition is done, the cutoff procedure is completed, but if you have bad experience or the customer doesn't pay you on time, then you can take a call on ECL. ECL again depends on the company's process, company's policies. So based on that, you have to create that ECL. So this is all about revenue recognition and revenue cutoff procedure. If you have any specific doubt, put your question in the comment. I'll reply on that. Thank you.